Welcome, friends. In this episode, let us discuss something about the debt trap. A government has to work as the development state, and the basic requirement is to create the infrastructure so that the economy can grow, economy can develop. For creating infrastructure, the government has to spend, the government has to invest, for which government needs money. Its second role is what is called as welfare state. In this role of the government has to spend for creating provisions, providing services at a reduced cost or free of cost for the people in the country, for which also the government has to spend. So on one side, this is the requirement on the part of the government to spend for infrastructure, to spend for welfare schemes. But on the other hand, the government has limitations to collect revenue. The revenue may be tax revenue or non-tax revenue. However, because of the state of development of the economy, well, there may be limitations for collecting the revenue by the government. So on one side, there may be shortfall of revenue. On the other side, there may be requirement of spending more and more on infrastructure and welfare schemes. The gap in these two is required to be bridged, and for that, government may resort to borrowing. In 1930s Great Recession, when this position of all the economies was of low economic activities, low demand in the market, and therefore low production, low employment, etc., it was advocated that time that government should keep on investing, keep on spending, so that people will get money and they will start placing the order in the market. And thereby the recession can be overcome. For which it was advised that let there be no relationship of volume of currency with the stock of gold, and the gold standard was given up slowly and gradually by all countries in the world. Naturally, the countries started issuing currency on a very large scale. Secondly, the banking industry developed and expanded, because of which the banking facilities, particularly the advances, were made available easily, and also it was at a lower interest rate. And the third thing is, about 1900 or 1990 decade, the globalization process took some momentum. And because of this globalization process, the capital of one country started moving to other countries. So the flow of capital, the flow of money started on a very large scale. These were the three main reasons. Countries issuing currency on a very large scale because the relationship with gold was discontinued. Second, development of the banking sector. And third, allowing the foreign investment to move from country to country. There was ample money in the international market, and the governments were able to raise loans very easily at affordable interest rates and on acceptable terms. So this is the reason why the loans started increasing. But what happens is, if you take the loan and if you don't invest it in productive projects, then naturally the government doesn't get increased revenue. So what is expected? What is a wise decision? Wise decision is there is no harm in taking the loan. Government may take the loan and go for infrastructure development, go for increase in the economic activities. But this investment should be made in such a way that the projects will yield more revenue to the government, directly by way of taxes or indirectly by way of dividends, interests, etc. In other words, if the growth of GDP, the rate of growth of GDP is more than the rate of interest the government is required to pay on loans, in that case, the government will find no difficulty in repaying the loans, because every loan raised is required to be serviced. In other words, on that interest is required to be paid and repayment has to be made, for which the income should be generated from the investment of this loan amount taken by the government. This is a simple equation. So many times what happens is, the rate of GDP growth is more and the rate of interest rate is low, the government is safe. But if it happens otherwise, that is, interest rate is high and the GDP growth rate is low, then the government is not able to service the debt. And if it is not able to service the debt but has to repay the loan and pay the interest on it, government has to borrow again. And this borrowing goes on increasing in that case. So if interest rate goes up, then the balance of the revenue with the government will come down. With less amount available for investment, less amount available for welfare schemes, government borrows again, and this cycle continues. So this is called as debt trap. Government is required to borrow even for making the payment of interest and repayment of loan. This is a very, I may say, dangerous situation for any economy. And we know that because of this, if your borrowing is within the country, then the interest rate, domestic interest rates will go high. If they go high, inflation will start spreading in the economy. If these loans are taken from outside, that is foreign loans, in that case there is a chance of exchange risk as well as the exchange rate risk as well as the devaluation of currency risk. Because the foreign loan is required to be repaid, or the interest on that is required to be paid in the form of foreign currency only. And if the economy is not working well, there is a possibility that the value, the exchange rate of the local currency may be adverse. So you will have to pay more for the loans taken in foreign currency. Similarly, if the economy is not doing well, the value of the currency will go down. That is called as devaluation. And both these things are dangerous to any economy. And the world has experienced the problem of debt trap in case of few countries very recently, like Spain, like Italy, or like Greece. So what is required to be done? There is nothing wrong in borrowing. Only caution that is required to be taken is borrow as less as possible. And secondly, if you borrow, then see that you get the amount of loan on favorable terms with low rate of interest. You have to have the balanced budget. And lastly, the government should ensure that the amount of loan taken must be invested, must not be spent. It should be invested in creating the assets, and these assets should increase the revenue of the government. If these precautions are taken, I think there are less chances of going into the debt trap. Thank you very much. We will meet in the next episode with some another economic concepts. Bye.